Imagine a company that is uh, growing its revenue by like 120%, right?
Right.
And they are sitting on this staggering $500 million in cash.
Which is huge.
Yeah, it's massive.
Yeah.
And on top of that, they're selling a product that the European government has literally made it illegal not to buy.
Exactly. The regulatory tailwind is just insane.
But then, imagine that same company's stock is trading at like $2, hovering dangerously close to its 52-week low. So today, we're welcoming you to a deep dives where we are going to unpack what I think is the ultimate market paradox.
It really, really is. I mean, it's one of the most profound disconnects between actual business performance and market pricing that you can find out there right now.
Yeah, it's like finding a fully loaded futuristic spaceship sitting at a used car lot, with a discount sticker slapped on the windshield. It just doesn't make sense.
That's a perfect way to look at it. So the company we're looking at today is called SEALSQ. And the core question we need to answer for you today is whether this deep discount is, well, a classic value trap.
Right, meaning the market knows some fatal flaw hidden deep in the business that we don't.
Exactly. Or, on the flip side, if this is an asymmetric, multi-billion-dollar opportunity in a completely new foundational sector of technology.
Right, because when you see a valuation that is that disconnected from the headline numbers,
Yeah.
your brain immediately starts looking for the catch.
Of course it does.
But to figure out if the stock is actually mispriced, we first have to understand what this business is doing in the physical world.
Yeah.
Like, why are its revenue numbers suddenly spiking so violently?
Well, SEALSQ is currently hitting a massive revenue inflection point. I mean, their preliminary first half of 2026 revenue came in at roughly $11 million.
Wow.
Yeah, and that is up 120% from the $5 million they did in the first half of 2025.
So it more than doubled.
More than doubled. And importantly, that growth is accelerating sequentially, so it's not just some one-off spike.
Yep.
Quarter 2 of 2026 brought in $7 million all on its own, compared to quarter 1's $4 million.
Oh, wow. So the momentum is actually building.
Exactly. The momentum is so aggressive that they recently raised their full year 2026 sales guidance. They expect it to land somewhere between $27.45 million and $36.6 million.
For a company dealing in physical, hardware-based security, seeing a sequential revenue ramp of that magnitude is incredibly significant.
It really is. It means the production lines are just humming and those purchase orders are actually clearing.
So we have to ask the foundational question here, which is why?
Yeah.
What is causing this sudden massive gold rush for their specific products? Because, hardware isn't software.
Right, exactly.
You don't just accidentally download 1 million microchips. Someone is actively, physically ordering these things.
It all comes down to their technological moat. SEALSQ specializes in post-quantum cryptography, or PQC, and specifically something called a hardware root of trust.
Okay, root of trust.
Yeah, they build the physical secure elements, chips like their QS7001, that protect devices from being compromised by quantum computers.
Right.
And this isn't some theoretical whiteboard concept either. Their technology is fully aligned with the strict post-quantum standards laid out by NIST, the National Institute of Standards and Technology.
Okay, let's pause and translate that real quick because hardware root of trust and post-quantum cryptography, that can sound like absolute jargon if you don't spend your days reading engineering white papers.
Fair point, yeah.
To understand why this is such a big deal, you have to understand the threat first. A quantum computer isn't just a really fast MacBook, right?
No, not at all.
It operates on completely different laws of quantum physics. Our current encryption, the stuff protecting your bank account, the power grid, military comms, it's basically just a really complex math puzzle.
Exactly.
It relies on the fact that standard computers would take thousands of years to guess the right prime numbers to unlock the data.
Right. Standard computers have to check every possible combination one by one. But a quantum computer, it can leverage quantum states to essentially look at all the possible combinations simultaneously.
Which is terrifying.
It is. Algorithms that would take a supercomputer 10,000 years to solve could theoretically be cracked by a mature quantum computer in, like, an afternoon. It is a literal existential threat to the entirety of modern digital infrastructure.
So what SEALSQ is doing with post-quantum cryptography is essentially changing the lock on the vault.
Yes.
Instead of a math puzzle that a quantum computer can just breeze through, they are creating cryptographic algorithms based on multidimensional mathematical structures that even a quantum computer gets lost in.
That's a great way to put it.
But the hardware root of trust is the physical part, right?
Yeah.
Explain that mechanism a bit. Like, why does it have to be physical hardware?
Well, that's the critical distinction. A root of trust is a physical, unalterable vault built directly into the silicon of a microchip. Because if
Yeah.
you only use software to protect your cryptographic keys, well, malware can just infect the operating system and steal those keys while they're being used.
Right, software can always be hacked.
Exactly. So a hardware root of trust isolates those keys in a physically separate, hyper-secure enclave on the chip itself. It acts as the foundational anchor of trust for the entire device. If you don't have that physical anchor, the rest of your security stack is effectively built on sand.
So they have the physical vault, and they have the quantum-proof locks. I mean, that's a great product.
It's an essential product.
But great products don't always equal 120% revenue growth overnight, right? The real catalyst here is the government stepping in, isn't it?
Oh, absolutely. The primary driver of this revenue spike isn't just corporate paranoia about quantum computers. It is aggressive, immediate regulatory mandates.
Right.
There are two massive catalysts currently in play right now. First, the European Union's Cyber Resilience Act, and second, the new ANSSI post-quantum mandate in Europe.
So the regulators are moving in.
Big time. These regulatory bodies are no longer issuing, polite recommendations for critical infrastructure to upgrade its security. They are enforcing compliance. Yeah, they are legally forcing enterprises, defense contractors, and governments to transition to post-quantum hardware immediately.
So wait, the EU basically just legally mandated their product category into existence.
Essentially, yes.
It sounds like they're selling umbrellas,
Yeah.
and the government just passed a law that everyone must hold one in the rain or else you get fined.
That is exactly the dynamic, and it creates a brutal regulatory moat for their competitors.
Well, how so?
Well, if you are a cybersecurity company that only offers software solutions or, you haven't spent the last 5 years getting your hardware rigorously tested and certified to these new post-quantum standards, you're suddenly legally locked out of the European market.
Oh, man, so you can't even compete.
Right. SEALSQ has the certified hardware ready to ship right as these mandates are being strictly enforced.
Okay, so they have a captive market mandated by law, and they have triple-digit growth. But here's where the financial reality gets completely fascinating to me.
Okay, let's hear it.
Usually, a company at this stage of the hardware lifecycle, like experiencing rocket ship growth, desperately trying to scale up physical manufacturing to meet these sudden government mandates, they're usually starving for cash, right?
Oh, yeah. Building microchips is astronomically expensive.
Exactly. They're usually burning through capital just to keep the lights on and fulfill the backlog of orders.
Yeah.
But then you look at SEALSQ's balance sheet.
Yeah, and it is genuinely staggering for a company of this size and in this specific growth phase.
Right.
As of June 30, 2026, SEALSQ is sitting on approximately $495 million in cash and short-term investments.
Almost $500 million in the bank.
Precisely.
Yeah.
Now, to understand where that money came from, we have to look at a $125 million registered direct offering, or an RDO, that they completed back in March of 2026.
Okay, let's stop right there, because registered direct offering is one of those clinical financial terms that hides a lot of pain for retail investors, doesn't it?
It certainly can, yes.
When a company raises $125 million in an RDO, they aren't taking out a bank loan. They are issuing a massive amount of new shares directly to institutional investors, right?
That's exactly right.
Which means if I owned a slice of the company before March, my slice just got heavily diluted.
Yes, and you've just put your finger on the first major piece of the pricing paradox here.
Okay.
While the business itself is flush with cash, the existing shareholders absorbed a significant dilution event to make that happen. The company printed new shares to raise that capital, which inherently drives the price of individual shares down.
Right.
However, you have to look at the sheer size of the total war chest. I mean, nearly $500 million gives the company a level of operational security that is incredibly rare in the small cap hardware space.
So instead of giving investors their money back, they're hoarding it. Like, what are they actually doing with all that cash? Because they certainly aren't paying it back out as a dividend to apologize for the dilution.
No, definitely not returning capital via buybacks or dividends right now. Instead, they are reinvesting it highly aggressively.
Okay.
They've created what they call the SEAL Quantum Fund, which has a target allocation of $200 million. And their stated strategic goal is to build a fully integrated quantum vertical sovereign stack.
A quantum vertical sovereign stack. I mean, that sounds like something out of a sci-fi novel. What does that actually mean in practice?
Well, think about the geopolitical anxiety surrounding quantum computing right now. Europe does not want to be entirely reliant on American or Chinese technology to secure its critical infrastructure against quantum threats.
Right. You want their own stuff.
Exactly. They want sovereignty, complete domestic control over their security supply chain. And SEALSQ is trying to build that entire vertical stack themselves. They recently signed a $5 million commercial agreement with a company called Quably to integrate quantum technology directly into silicon computing platforms.
But that's just a commercial agreement, right? Just a partnership. I mean, the bigger move is the acquisition rumor, isn't it?
Correct. The much larger speculative catalyst here is an active memorandum of understanding regarding a potential full acquisition of Quably by SEALSQ.
Which would be huge.
Massive. If they consummate that deal, the company fundamentally transforms. They transition from being just a component supplier, selling a specific security chip, into a rare, pure-play quantum computing entity.
Oh, wow.
Yeah, they would own the hardware fabrication, the security protocols, and the quantum computing integration itself. Basically, they're trying to monopolize the sovereign European quantum supply chain.
So wait, instead of giving investors their money back, they're basically hoarding it to build this sovereign stack. Is this a brilliant monopoly play, or are they just playing quantum monopoly with $500 million?
Well, that's exactly the debate in the market right now, because to summarize the bull case, you have a company growing at 120%, backed by European legal mandates, forcing customers to buy their tech, armed with a $495 million war chest, and aggressively buying up the supply chain to become a domestic quantum monopoly.
Which brings us back to the ultimate question. If I open my brokerage app right now and pull up the ticker, the chart looks like a horror movie.
It really does.
I mean, the last recorded price in our sources is $2.36. That is dangerously close to its 52-week low of $1.99 and massively down from its high of $8.71. It's down over 37% year-to-date.
Yeah, it's been a tough run.
How does the reality of the business detach so violently from the reality of the stock price? Aside from the dilution we just mentioned, what is the market seeing that scares them so much?
Well, to understand the fear, we need to look at a few specific financial and technical metrics.
Okay, let's hear them.
First, let's talk about valuation. SEALSQ's price-to-sales ratio over the trailing 12 months is sitting at about 23.5.
Meaning, for every single dollar of sales the company actually generates, the market is asking you to pay $23.50 just to own a piece of it. I mean, even for a hyper-growth tech stock, that is a very steep premium. You are paying heavily for future potential, not current reality.
Exactly. It's elevated, even in the semiconductor space. But the metric that truly defines the chaotic trading of this stock is its beta. SEALSQ has a highly unusual, frankly extreme beta of negative 8.38.
Okay, wait, let's break down what that negative 8.38 actually means for the person holding the stock.
Go.
Because a beta of 1 means your stock generally moves in a perfect lockstep with the broader market, right? Say the S&P 500.
Correct.
A beta of negative 1 means it moves in the exact opposite direction. But negative 8.38, I mean, that doesn't even sound mathematically stable. What specific market forces cause a stock to behave like that?
It basically indicates that the stock is completely decoupled from macroeconomic reality.
Wow.
When a stock has a beta that extremely negative, it means it is trading entirely on its own idiosyncratic news cycle, highly speculative retail sentiment, and potentially complex short-selling dynamics.
So it's just off in its own world.
Completely. It is not moving because interest rates changed or because the broader tech sector rallied. It is operating in its own high volatility vacuum.
So it's essentially a coiled spring. If the broader market sentiment shifts, or if there is a sudden influx of volume, the upward or downward moves aren't going to be 5 or 10%. They're going to be violent, explosive swings.
Precisely. And that extreme volatility makes institutional investors very wary.
Right.
But there is another layer to the market's hesitation, and it has to do with insider sentiment and behavior.
Okay.
While we see institutional capital flowing into strategic partnerships, like, for example, the MOU they signed with Global Foundries to co-develop secure semiconductors, the internal executives at SEALSQ are actually reducing their exposure.
Oh, really?
Yeah. Over the last 90 days, the net insider shares have dropped by over 66,000. We are looking at 18 individual insider sell transactions compared to only 5 buys.
Okay, I have to push back on the optimism here then.
Sure.
Because I get that an executive might want to buy a boat or diversify their portfolio after a $125 million capital raise, right? It provides liquidity.
Exactly. That is very common profit taking.
But 18 sells to 5 buys doesn't exactly scream, we believe in the mission to our absolute core, right? If you are the management team building the foundational sovereign stack for the future of European cybersecurity, shouldn't you be mortgaging your house to buy more shares at $2.36? Why are they running for the exits?
It is a totally valid critique, and honestly, it perfectly transitions us into the bear case.
Yeah, let's get into that.
Because the market isn't just punishing this stock because of insider profit taking or historical dilution. They're punishing it because of severe fundamental operational risks. The execution risk here is monumental.
Right, let's turn over the rock and look at the ugly stuff. Because despite this amazing top-line revenue growth we talked about, the company is deeply, deeply unprofitable.
Oh, absolutely. The net margin right now is an alarming negative 234.84%.
Ouch.
And the earnings per share is sitting at negative 43 cents.
Negative 234%. Let's make that real for a second. That means for every single dollar they bring in from selling a microchip, they're spending almost $3.50 to generate that sale.
Right.
Where on earth is all that money going?
Well, it goes entirely into research and development, aggressive ecosystem expansion, and the sheer physical cost of hardware fabrication.
Which isn't cheap.
Not at all. Designing a post-quantum chip, testing it against quantum algorithms, getting it certified by regulatory bodies, and then physically manufacturing it in a foundry requires immense upfront capital.
Right.
Management's argument is that this massive margin contraction is intentional. They are spending heavily right now to dig the moat deeper.
So they're front-loading the cost.
Exactly. The expectation is that once the products reach full commercial scale across Europe, the R&D costs will flatten out and those margins will reverse into profitability.
But that is a colossal if.
Yeah.
The stakes are incredibly high here. They're citing a commercial pipeline of $225 million in potential contracts, right?
Yes, potential contracts.
If they fail to convert those potential contracts into actual high-margin sales, that $500 million cash pile isn't a safety net. It's just fuel for the furnace. It will burn up quickly.
And it isn't just R&D burning that cash either. We discussed the potential acquisition of Qualbly, but they are also aggressively buying and investing in other strategic companies like ICALPS and Mirix.
And this is where the true execution risk lies. This is the part that terrifies me.
Why is that?
Because integrating one highly complex, deeply technical, specialized tech company into your existing operations is notoriously difficult. Mergers fail all the time just on culture clashes alone.
Oh, absolutely.
But trying to integrate 3 or 4 cutting-edge quantum technology companies simultaneously, it sounds like they are building an airplane while in free fall. Sure, they have $500 million in parts, but if they don't screw it together right and fast, they still crash.
That is a brutally accurate metaphor for the complexity involved here. You are dealing with disparate engineering teams, conflicting software architectures, entirely different corporate cultures.
Yeah.
If the management team gets distracted by the logistics of the mergers, or if the technological synergies they promised just don't mechanically work when plugged into each other, the entire thesis falls apart.
So they could end up heavily diluting their shareholders to build a bloated, disjointed corporate structure that dilutes shareholder value even further.
Exactly. The market sees all the expensive parts in free fall, but they don't trust the mechanics yet. They are taking a show-me approach before they assign a premium valuation to the stock again.
Which brings us to the most practical question for you listening right now. Knowing the incredibly high stakes, the cash burn, the regulatory tailwinds, and the complex mergers, what is the timeline here?
The catalyst calendar.
Yeah. When do we actually find out if the airplane flies? What does the calendar look like for the next 3 to 24 months?
Well, in the immediate short term, all eyes are on the final audited H1 2026 results and the upcoming Q3 updates.
Okay.
The crucial metric is consistency. They must definitively maintain that 50 to 100% year-over-year growth guidance they've promised to the market.
And if they don't?
If there is even a hint that growth is slowing down while margins remain at negative 234%, the market will punish the stock severely.
Okay, so that's the short-term survival check. But what is the major inflection point?
The defining moment happens in the second half of 2026. H2 2026 is critical because SEALSQ expects to receive the CCEAL5 plus evaluation technical report.
All right, CCEAL5 plus MILID. More alphabet soup. We need to decode this for the listener. What exactly is this certification and why is it so important?
Sure. CC stands for Common Criteria, and EAL5 Plus is an internationally recognized, incredibly stringent evaluation assurance level for computer security.
Okay.
To understand how difficult this is to get, imagine handing your microchip over to a team of world-class cryptographers and hardware hackers and letting them spend months trying to physically and digitally tear it apart.
Just ripping it to shreds.
Exactly. They examine it molecule by molecule to find a backdoor or a vulnerability.
So this is the ultimate stress test.
It is. EA5 Plus means the product has been methodically tested to withstand highly sophisticated targeted attacks. To put it bluntly, without this specific certification, you legally cannot sell your hardware to European governments, defense contractors, or critical infrastructure providers.
Wow. It doesn't matter how good your marketing is.
No, without EL5 plus Paker, you are locked out of the biggest contracts in the world.
So it is the golden ticket.
It is the key that unlocks major government procurement contracts. Getting this formally proves that your hardware root of trust is effectively impenetrable.
And they expect that when?
In the second half of 2026. Additionally, by the end of H2 2026, they expect to see the initial commercial revenues rolling in from their QVault TPM product.
So the clock is aggressively ticking on the second half of 2026. For you listening right now, is this CCEAL5 plus report basically the starting gun?
Yeah.
Is that the moment the real money either shows up or doesn't?
For institutional investors, yes, that is the trigger they are waiting for. However, it is vital to understand that the overall investment thesis outlines a multi-year hold.
Right.
It requires a 12 to 24-month horizon for the post-quantum hardware pipeline and the Quably acquisition to fully mature.
Let's do a quick wrap-up and pull all of these threads together because there is a lot to weigh here.
Definitely.
SEALSQ is this high-risk, high-reward, pure play in the post-quantum security space. You have an undeniable, massive regulatory tailwind driving sales. You have a fortress of a balance sheet with nearly $500 million in cash and accelerating revenue.
But on the flip side, you have deeply negative margins, a history of dilution, and monumental execution risks as they attempt to integrate all these complex acquisitions.
Right. It is the ultimate high-wire act. They have the capital, they have the legal frameworks. Now they just have to prove they can actually put the pieces together without crashing.
Exactly.
Before we let you go, I know you always like to leave us with a broader philosophical takeaway. When you look at all the pieces on the board here, what is the biggest implication for the future?
Well, if we zoom out from the balance sheet, it leaves you with a deeply provocative thought. We are entering an era where global governments are legally mandating specific quantum-secure technologies to protect critical infrastructure, right?
Right. Power grids, banking systems.
Exactly. So will the private companies holding these specific patents and certifications become the new essential utilities of the digital age?
That's a massive shift.
It is. We are accustomed to massive global banks being labeled too big to fail. But as post-quantum cryptography becomes the literal bedrock of national security, could a private company providing the foundational security hardware become effectively too important to fail?
Wow.
Could a company like SEALSQ achieve a level of sovereign importance that guarantees its survival long before they ever even turn a profit?
That completely reframes the entire conversation. If a sovereign government mandates that your specific microchip is the only thing standing between their electrical grid and a catastrophic quantum attack, they probably aren't going to let your company quietly go bankrupt.
Yeah,
right?
exactly.
It adds this whole shadow layer of geopolitical backing that changes exactly how you look at a $2 stock price.
It really does.
Well, thank you so much for joining us today for this deep dive. The post-quantum landscape is shifting incredibly fast, and it just goes to show that sometimes the most fascinating opportunities in the market are wrapped up in the ugliest stock charts.
You just have to know how to read the underlying blueprint.
Exactly. Keep exploring the margins, keep questioning the consensus, and we will catch you on the next deep dive.